This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We're going to look at question 3 from the December 2013 paper F9 exam. So as always, let's quickly look at the requirements first. Part A, calculate the following values for product P. Total cost of current ordering policy, total cost using economic order quantity, net cost or saving. This is obviously, this part is obviously on economic order quantity. So we're working capital. Part B, calculate the net value in dollars of accepting early settlement discount for product Q. So rather a separate question here. A was about product P, this is about product Q, and it's talking about discounts. Part C, discuss, so no calculations here, how invoice discounting and factoring can aid the management of receivables. Well, that's very much textbook. Hopefully you've read about those, in which case it should be reasonably easy to get good marks. And finally, Part D, again very much textbook. Identify the objectives of working capital management. Discuss the central role in financial management. So again, pure discussion. There's 13 marks here at C and D discussing. Both of them are fairly standard textbook sort of questions. Anyway, let's make a start. First of all, Part A. It's only asking about product P, so we don't need to waste time reading about product Q. Product P, the annual demand is 300,000 units. An order for new inventory is placed each month. Orders cost $2.67 to place. The cost of holding in inventory is 10 cents a unit a year. And there's buffer inventory of 40% of 1 month's sales. And Part 1 wants the total cost of the current ordering policy. And although he hasn't said, I think fairly obviously, he'll want it the total cost over a year. And there are two costs to consider. First of all, the order cost. Well, it's $2.67 each time, and it says there's a new order every month, so with 12 orders at $2.67 each time, comes to a total of $3,204. In addition, we've got the holding cost. Well, how many units are we ordering each time? There's 300,000 units a year. We're placing 12 orders a year. So each order will be for 25,000 units. And so if we ignore the buffer stock for one moment, the inventory levels would be moving between 25,000 and 0. The average inventory would be 12,500 units. In addition, though, we do have this buffer or safety inventory. And so, throughout the year, we're keeping extra inventory to be safe, and the extra, it says, is 40% of 1 month's sales. Well, it's 25,000 a month, so there'll be an extra 10,000 units kept for safety. So that 10,000 is always there. In addition, we've got these 25,000 units coming in a month. On average, an extra 12.5. Well, at 10 cents a unit a year, an extra 2,250, and so the total cost 5,454 per annum. Well, that's the current ordering policy. Part 2, though, says what would it be if we used the economic order quantity? Well, you've got the formula on the formula sheet. The economic order quantity is root 2 COD over CH. CO is the order cost each time, which is 267. D is the total demand per year, 300,000. CH, the cost of holding 1 unit for a year, which is 10 cents. which gives an economic order quantity of I get 40,025 each time. Now in the formula itself, buffer inventory is irrelevant because the buffer, we're going to keep that extra inventory throughout the year whatever happens, so that cost would stay the same. The only thing that will affect the other costs, or all the costs, is the size of the order. Anyway, let's now cost it out. The order cost, well, we're ordering 300,000 a year. This time 40,025 each time. So how many orders will we need? Um, 7.5 orders a year. Now I appreciate you can't place 7.5 orders a year. Some years will be 8, some years will be 7. But we think of this as long term, so on average it'll be that many orders. And so the total order cost, 2003. In addition, the holding cost, well, same idea as before, but the average inventory, if we ignore the buffer, it'll be 40,025 over 2, which is 20,013. In addition, we've got the buffer stock. Well, as before, it's 40% of 1 month's sales, another 10,000. And at 10 cents a unit is 3,001. Total 5,004. There may be a bit of rounding there, but not worried about that. So that's part 2. Part 3. It's only 1 mark, but this is an easy mark, even if you'd got your figures wrong in 1 and 2. The right mark, you get the mark for doing the right thing. But what's the net cost or saving? Well, here there'll be a net saving. The current policy is costing 5,454 a year. The new policy 5,004. So a net saving of 450 per year. So there we are. How many marks? 7 marks. That's not a bad start, not too difficult. Part B. Completely separate here, so whether A was easy for you or difficult, Part B, calculate the net value in dollars to plot company of accepting this early settlement discount for product Q. So it's only Q we're interested in here. It says the annual demand for Q is 456,000 units a year. We buy this product at $1 per unit, 60 days credit. The supplier's offered an early settlement discount of 1% if we settle within 30 days. We finance working capital with short-term finance costing 5% a year. Assume that there are 365 days in a year. So although normally discounts in this exam are to do with receivables, here it's payables, but it's exactly the same logic, the same sort of approach. And again, although he hasn't said, I think he should have done, but when he talks about the net value, we're really looking at what's the cost or saving over a year. And so, let's have a look. Well, first of all, there's a very obvious potential saving if we take the discount, in that we get a discount. And over the year, how much would that save us? It's a 1% discount. Purchases of 456,000 units a year. At the moment, we're paying $1 each. So we'll save 1 cent a unit in total over the year. we'd save 4,560. However, we've got to contrast that with the cost there'll be of paying early, in that it'll cost us more in terms of interest costs. We're paying interest at 5% a year. If we're paying earlier, it'll cost us more interest. Now, there's more than one way you could do this. What I'm going to do is let's calculate what the current average payables are. Well, on average, we're not taking the discount. And we are paying, what is it, 60 days. So on average, our payables on the balance sheet will be 60 days worth of purchases, and the total purchases 456,000 at $1. So over the year we're spending 456,000. If we're taking 60 days to pay, on average our payables will be 74,959. If we do take the discount, then the payables will fall, the new average payables, the discount we'll be taking 30 days credit, so on average it'll be 33/65 of our purchases. We're still buying 456,000, albeit the total cost, there's a 1% discount, so it'll only be 99% of $1. And so the average payables I get 37,105. And so currently, throughout the year, you've got payables of 74,000. In future, throughout the year, payables will be 37,000. And so throughout the year, there'd be a fall in the payables of the difference of 37,854. And if throughout the year payables fall, then throughout the year it's costing us the extra 5% interest on that. So the interest cost, remember, it falls by that much throughout the year. Throughout the year, payables are 37 less, or working capital as a result is 37 higher. The yearly cost is 5%. And so the interest cost I get to be 1893. And so the net value, well, here there is going to be a net saving. We save 4,560 on the discount, but we spend, we've got an extra cost of 1893 on the financing. A net saving of 2,667 per annum. So again, I don't think too bad. But equally, the nice thing is that even if there was a problem, it doesn't affect Part A, and in a second, it doesn't affect either Part C or Part D. C and D are very much independent. Part C, discuss how invoice discounting and factoring can aid management. I think really you need two things here. I mean, as always, I'm not going to write a full answer. It'd just get boring to watch me writing, but let me make the points that are needed. I think there are two things needed for each. I think you need to explain basically what invoice discounting is, and what factoring is. So I think it's part explaining what they are and partly what's the benefit, how can they help manage receivables. Well, first of all, invoice discounting. What this is where you have an invoice, a customer, let's suppose a customer owes you 10,000 payable in 2 months' time. A way of getting the cash sooner is effectively to sell the invoice to a bank. You'll get the cash now, but because they're giving you the cash immediately, they'll give you less cash. So effectively, sell an invoice to the bank. You get cash immediately. But you get less than the invoice value. That's the bank's charge, the discount. And what's the benefit of that? Well, it's not something you'd normally do regularly. The real benefit is that it will help short-term cash shortages. If we find out this month, for some reason we're short of cash, there's an alternative to having to arrange an overdraft or borrowing in other ways. A short-term way might be to sell, if there's a large invoice outstanding, sell it to the bank. Again, it solves a short-term cash problem. On the other hand, factoring is more of a long-term policy. It's where you use another company the factor to collect the debts. And the potential benefits of that: more efficient collection. This company specialises in it. And so hopefully they'll get the cash in sooner. A second benefit, saved admin costs. We don't need to employ our own people to chase debts. We use the factors instead. Another benefit, if we want it, the factor for a fee will advance money to us. So whereas it might take the factor a month to collect receivables, maybe they'll give us 70% of the money immediately, albeit they will charge interest on it. And I'm not sure he'd really expect you to mention this, but again, for a fee, it is possible to get non-recourse factoring. And non-recourse factoring is where we're guaranteed there'll be no bad debts. Although, of course, if we go for this, we will be charged a fee. So there we are. And again, I always say that it's hard to get 6 out of 6 or full marks on a written. But provided you had read your textbooks or notes, or whatever, you should certainly be able to get reasonably good marks there. Finally, part D, the objectives of working capital management, and discuss the role of it. Now, it's a bit difficult. There's a bit of a what you might call a crossover there. But do at least write something for each bit. You know, there are effectively two questions. The objectives of working capital management. In basic terms, it's to balance liquidity with profitability. And what we mean there, in terms of liquidity, we want to make sure that we've got a good cash flow, that we can pay our liabilities, on the other hand, when it comes to profitability, working capital itself isn't earning us money. We'll make more profit if cash is invested in profit-earning assets. So, you know, rather than have cash tied up in working capital where it's not actually earning profit, if we use the cash to buy more machines, that would generate potentially more profitability. Now, you can say the same thing in several ways, but that's really what we're getting at, that we need to watch our working capital to make sure that we don't go bankrupt, we don't have liquidity problems. At the same time, we don't want working capital to be too high, because that's taking money away that could be in non-current assets that could be generating more profit. When he said discuss the central role, well, it's very much the same sort of thing, that working capital needs financing. And so, in terms of financial management in general, we need to decide how much short-term finance and how much long-term. You should have seen in answers to previous exams, there's quite a lot you could say there about different policies, aggressive, conservative. I don't think he wants too much here, given it's 7 marks in total, but it is an important financial management decision, how to raise the finance and at the same time we need to control the level of working capital. We need to use it efficiently. And parts A and B were examples of that determine the most sensible inventory ordering policy. Make decisions such as in part B as to whether to take discounts from suppliers, similarly receivables, whether to offer discounts to customers and so on.